Want to know how you can gain access to capital to jumpstart your journey to entrepreneurial success? For entrepreneurs who are just starting out or those who have been in business for years, Minority Business Access is your podcast. Welcome to our show, where we will guide you in avoiding the pitfalls and thriving in your chosen business. Now, onto the show with your host, Solomon Ali.
Hey guys, I am so glad to be back here with you again to share another episode of Minority Business Access. We're going to talk about due diligence. The team has gone out and found a really exciting video that talks about due diligence. They give a whole bunch of nice, really awesome points, and we're going to kind of collaborate a little bit, and I'm going to weigh in on it, and we're going to get right to the nitty-gritty on it. Guys, if you have questions, please don't be afraid to reach out to us. Ask your questions, get an answer. Someone on my team will answer. Go to solomonrcali.info. Get your questions answered, please. Don't take the next step being uncertain, unsure of what to actually do. Trust me when I say it's a minefield. You need someone to help navigate you through that minefield. Whether it's me, McKinsey, whatever consulting company you can go to that can help you and guide you, you need to get the help so that you can navigate the minefield. You have to go to people who already know, been there, done that, okay? Very important. Again, let me just say, hey, thank you so very much for tuning in to Minority Business Access. I hope we give you some really important information that you can use in your journey to becoming successful, because it is truly all up to you. So we're going to get started with, hey, how to do due diligence, what it's all about, and some key things. The guy has a really good video, so please pay attention, listen real. You may want to listen to it a few times, okay? We're going to play the video.
Welcome to the Finance Storyteller series. This video covers 10 tips for a solid due diligence in the merger and acquisition setting. First of all, take it seriously. A due diligence is much like the process you would go through when buying a house. The seller has an obligation to disclose significant items related to the condition and history of the property, and it's the buyer's responsibility to be completely aware of past problems before signing on the dotted line. Be aware that the due diligence isn't just a quick check the boxes exercise in between the deal negotiation and the official deal signing.
People want you to understand, what he's talking about is really good stuff, okay? Due diligence is kind of like doing the due diligence on a home. It's a little more complicated than doing the due diligence on a home. Why? Because you have to investigate the historical numbers, all right? You're looking at 3 years of historical numbers, all right, on the business. Sometimes you may even need to look at 3 years of historical numbers on the person themselves. So if you're buying a business, you definitely, or you plan on loaning the company money, you're definitely going to want to do this. 3 years of historical numbers on the business, 3 years of historical numbers on the person, okay, or the owners of that business. Because you're looking to see how the money interacts and goes, okay, from the business to the owners and back and forth. You're also looking to see if there's any commingling. Commingling is when the money just goes back and forth, okay? So you're looking for things like that. But in your due diligence process, don't be afraid of it. Don't be intimidated by it. You're just being the investigator. Remember, due diligence, investigator, homework, all the same thing. That means all the same thing, all right? So what you're going to do is start with the financials on the business, all right? And then you're going to move to the personal financials. That's if you're buying the business. If you're just an investor, okay, looking to buy into a stock, you're going to look at all the company's financials. You're not going to look at the person's personal financials. Please hear me. If you are an investor just buying stock, most of the time that means you're going to be probably buying stock retail to determine whether or not it's a good investment, okay? You will only be looking at the business financials. You will be looking at their 10Ks, their Qs, their 8Ks, Those are the kind of financials you would actually be looking at. And you will be reading the MD&A section, okay? Very important. And it must be done. And like he's saying, you just don't want to say, oh, okay, I pulled it offline, I'm checking the box. Oh, I had the company give it to me, I checked the box, it's done. You have to read it. And some of it you may have to compare it to the competition that's out there, please. Very important, okay, people? Very, very important. So, you know, one of the things at Solomon R.C. Ali Corporation, what we do is this. When we're looking to help a company, we pull both their personal as well as the business, because we got to help them put a strategic plan together to be able to scale their business. So we're looking what has been their pitfalls, what has been their great success, what makes the business run, how well and efficient have they been running the business. So we try to determine all of that. We also want to know the weaknesses so that we can shore up those weaknesses when we're helping them to put their package and everything together for their strategic growth. So that way that we can arrange the money for them and that they'll get access to the type of monies that they need to go off and do bigger and better things, okay? Another thing that we look at is when we're doing due diligence, we're looking to do due diligence on several or multiple acquisitions at one time. Well, can the company, when we turn around, is the company financeable? Does the company have the ability to leverage its credit, to leverage any assets, things of that nature? So these are the type of things that we're looking for. And it helps us to come up with the right strategy, okay? So we're going to get back to the video, and we're going to see what he has to say, and I'm going to just keep chiming in. And I'm probably going to chime in more on this one than I have in the past, because I also think this is a very valuable tool here, and it's very important to your success in investing. It's very important to your success in running and managing a company as well.
If the outcome of the due diligence is not satisfactory, it might lead to cancellation of the deal. On the flip side, be careful not to get carried away with insignificant items. We are looking for material risks and want to see things in the right perspective. Due diligence is resource constrained and time sensitive by definition. How many people should you have on the due diligence team? How much time do you plan for it? Be aware that the due diligence is very hard work, both for the team on the buyer side as well as the team on the seller side. If you overdo it, the due diligence might get in the way of normal business operation.
People, there's no doubt about it. Due diligence, because the seller has to provide information constantly to you, all right? It's going to affect sometimes, if they don't have other people that can get them, it's going to affect their day-to-day operations. At SolomonRCAli.info, okay, hey, we have attorneys, we have accountants, we have auditors, we have independent people. You know, we have pretty much about this many people, okay, right here. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Well, we'll probably have a few more than that, give or take. And I'm being serious, because we have people who are looking at different parts of the information. We have a 7 or 8 page due diligence package that has 7 parts, and kind of like the government, that each part has sub-parts all the way through. So by the time you turn stuff in, you're probably turning those files in. It's about 1.5 to 2 feet deep, okay? Literally, okay? It's huge. That being said, but the experts, the attorneys, are looking and examining contracts. They're telling us what contracts are weak. Okay, which contracts may hold up, may not hold up in court. What contracts can be leveraged and why they can or cannot be leveraged. So they're telling us that. The accounting people are telling us different things. The accounting people are telling us, hey, whether or not the books are correct, in the right order. Did they place everything there? And you'll be surprised how many people have accountants and things of that nature, and their books are totally screwed up and totally wrong. But because their management team or CEO doesn't know accounting or things of that nature, what they figure is, hey, I gave all the information to them. I thought they would put it together correctly. So we are normally, hey, well, let me say it this way. We come across that a lot, all right? We also have finance people there, all right? Finance people are letting us know, okay, based on these numbers, yeah, we can finance this or we can finance that. That's how this particular group will look at it, all right? And that's a lot of what I do as well, is get there and say, okay, yeah, this will be financeable with, let's say, Wells Fargo or B of A. It meets their criteria, okay? Or no, you can't go there. We're going to have to go to private financing, like a private equity company, or a network of investors, or an investment pool or investment club. So there's different places we have to take you to arrange the capital based on your historical numbers and based on what has been done. All right, and that's very important, and that's all discovered in the due diligence, and the plan comes out of the due diligence. So people, don't be embarrassed or ashamed of the work that you have done in the past or your professionals are supposed to do. You're coming to a high end at the end of the day to put a very, very important plan together for you for the scalability of your company, for the growth of your company. You're ready to take it to the next level. That's why you're bringing in a Solomon R.C. Ali Corporation, his team, okay, to take you to the next level. You're looking to be, oh, okay, I had one or two locations. I was a mom and pop. Now I'm looking to be a mid-sized company or a regional company. Okay, so those are the reasons that we do the things that we do and the kind of things we look for. We have marketing people that will look at it from their marketing hat and say, okay, this is how this would be marketed. Okay, so that's our due diligence team. That's kind of what makes up our due diligence team when we're looking at something. So our people are pretty proficient when they get down to it. And then, of course, you have me, all right? And so I don't get where I get to by osmosis. I get there by doing the work, people. And that's what we do, is do the work. We're going to go back to the video. I like it.
The first team.
In the due diligence, you know, something that I failed to mention is very important. And I just saw like a manufacturing at the bottom here, right? And that's taxes. People, you have to have
Every person.
a good tax professional. Don't get someone that just does taxes every year. You need a tax attorney to understand the complex, okay, if there's multiple locations and things of that nature within the business. So if you're buying a company that has 6 or 7 different units, a unit will be a subsidiary or a division, right? Right here, you have the flagship, you have your subsidiaries, and then, all right, so they have 5 subsidiaries. Now this may be in California, this may be in Jersey, this may be in Texas, this may be in Charlotte, all right? So there's different taxes that you have to look at, and hey, guess what? This one might be in Europe. So there's tax things that you have to take a look at that needs to be done in the due diligence to help you to determine what the tax breaks are, or if you do this, if you're buying it, is there going to be tax consequences? If you're selling it, what's the tax consequences? So due diligence is very important. If you're just basically looking to borrow some money, typically there won't be a tax consequence, okay? But hey, you might have what's called a net operating loss, all right? And if you have a net operating loss, believe it or not, guess what? Here's something that you probably don't know. There's people out there who's looking to invest in your company to take advantage of the loss so that they can bring their taxes down some. Wow, you should be shocked. Okay, I know I was when I first found out about that. I was like, wait a minute. If I do this deal, the person don't want to take my company or operate my company. They're just looking for a good tax break. So they invest heavily into my company, all right? Normally, they require a certain interest in the company so that they are able to take advantage of the tax break of the losses that I have had in my previous years. And people, that's extremely important to know, very important to know. See, that's where a Solomon R.C. Ali Corporation comes in. We do the due diligence, we do the homework. We're not guessing here. We're putting a very, very difficult plan together for the growth of your company. And all we ask is for complete honesty and transparency so we can get it done. Let's go back to the video, and I'm going to just keep chiming in because he's saying stuff and I'm just, chiming in and giving you other pieces of information you need to know.
On the other hand, if you don't assign sufficient time or resources, you might not get the quality you need. Assess the size and complexity of the business before you decide on team size and duration of the due diligence. Put together a diverse team. Every person has their own perspective on the world. In the due diligence, you need to look at things from as many perspectives as you can to capture as many insights as possible. So make sure you put together a diverse team in age, gender and functional background. Don't leave the due diligence just to the finance team or the legal team, but make sure you also have commercial, technical, IT, operations, logistics, manufacturing, sourcing and HR experts involved, depending on the nature of the business you are investigating.
Now, he's talking, if you're selling your business right now, to how to put the team together. When you hire the right consulting firm and everything of that nature, we have a team. We have a team that is very proficient in all the different areas, and we keep adding on to the team based on your business itself. It's like if we're investing in you or going to take the time to arrange capital for you, we have to know everything about your business so that your business is presentable, okay, is presentable to the investors, to the banks, all right? That's the whole key. In other words, we're going to tell you, when you go sit down, we're going to require you wear a suit, a tie. I know some of you guys, like right now in the day and age, you want to be dressed like I'm dressed right now or wear a suit with no tie and things like that. Guess what? Probably not going to get any money. They're not going to say it. They're going to think you look really good and really cool. Put the tie on. Don't be a jerk. Put the tie on. You're trying to get something. Go like you're going to church. You're the one that's looking for favor. You're the one that's looking for grace. You're looking for some mercy. You're looking to either get investors to come into your business to believe in you. Dress up, dress the part. Put the tie on, put the suit on. The next thing is like, look, industry insight is extremely important, okay? I didn't see that up here, but you got to have people who have industry insight. I'm not going to rely on my team if I'm the one on the buyer, on the seller side. I'm not relying on my team and my day-to-day people who run the operations to give all the industry insight. I'm bringing in a third party because I need to know what my competition is doing, truly doing. And I need to know how they're doing it so that when I go look for money, I'm able to turn around and pitch, hey, this is what the competition is doing, this is how we're doing it, and here's our secret sauce, and here's why it will work. You understand me? Okay. If I'm on the sales side, all right? Well, if I'm on the buy side, that was the sell side. If I'm on the buy side, I'm doing the same thing. I'm bringing in some experts because I'm trying not to lose my money. So you better believe when you're talking to investors, they're going to look at your information and they're not trying to put holes in it. They're trying to tear the dang thing apart. That's right. They're trying to tear it apart. They're trying to see where the holes are because once they put their money in it, they don't want it to be like old wine bags and just drizzle all out on the ground. So you need to understand that. All right? It's very important. And I know I'm putting money in it. I'm tearing every single thing and questioning every single thing you have to say in 10 different ways. And I'm serious about that because I'm investing real money. See, I know what the money is worth. I don't know what your vision of your company is worth. I know what you're hoping that it might be worth. I know what you say you're willing to work for. Okay, so due diligence is very important. The right team and everything of that nature. You know, you go through creative financing process. You're gonna go through we're looking at mergers and acquisitions, things like that. Is it more positioned for a joint venture? Is it positioned to go public? You know, so we're looking, what's the investment strategy? That's what that due diligence helps to determine. All right, we're going to get back to the video, so please keep playing this stuff back and listening to it over and over so you can get real familiar with it.
Thing to consider here is what the stakes are for each of the members in the team. Do they stand to gain or lose from the deal, financially or career-wise? That could impact their judgment. You want to select team members that are as objective as possible and probably need some independent external third-party team members for balance and credibility. Confidentiality. A due diligence is an intense project, probably with long hours at all kinds of locations, including planes and trains, overheated conference rooms, and possibly the local Starbucks. Be careful when discussing your due diligence. If you need to have a confidential discussion, do it at a safe location. Always use the code name for the acquisition target and make sure you come up with one that is not too obvious or too common. You won't be the first team that ever does a due diligence, so build on the expertise of others that have gone before you. There are generic checklists out there as well as industry-specific ones. Do consider that the company you are investigating is unique and you need to brainstorm with your team what the risk areas are. A useful tool for this is something called the failure modes effect analysis from the world of project management and Six Sigma. You brainstorm worst case scenarios, things that could go terribly wrong, and rate them on impact as well as likelihood. That helps you to prioritize the areas to investigate. After the site visits, document reviews and interviews are done, take your time to write a comprehensive report of your due diligence findings. Up front, you need an executive summary.
Now right here, people, if you hire Solomon RCLE Corporation, whether it's on the buy side or the sell side, we normally farm this piece out. So that report is going to come from an independent third party. So it's going to have a lot more credibility, all right, than what a Solomon RCLE Corporation says. Yes, we will hire the people to give a earnest opinion and evaluation of the company. And then they'll write that out and everything and say what their recommendations are, why this is their recommendations and everything of that nature. And so, even if it could be positive or it could be negative, but it'll be true and it'll be from a third party. So and that's very important to know. So it's not a document like if you're using us, we use a lot of subcontractors and vendors that actually come together to give us what we actually need. We just feel it's a more earnest way of getting the credibility and things like that, okay?
Which, if the due diligence went well, includes a statement like, in our opinion, based on the review conducted, we did not find any material defects or risks that prevent the transaction. Show how you have come to this conclusion. In your detailed findings, list your sources, cross-reference your documents, list who you spoke to and when you spoke to them. Be as factual as you can. As an aside, version control is key in writing the report. You might easily get up to version 20.
Clear communications. Clear communications. I can't think of a really good example, but here's what I'm going to say. Don't let people give you, we don't let people give us open-ended questions. We keep drilling down. We need to know exactly what it is that you're talking about. We can't think that you're talking about fruit, all right? We have to know that you're talking about oranges. That specific. Can't know that you're just talking about fruit. We're going to keep drilling down that you're talking about oranges. Then we're going to know what kind of oranges, from what region, So we keep drilling down because we need very, very clear communications. Because once the strategy is put together, you can't undo it, or we can't go back to the management team and say, oh, well, they meant this. Or they can't come back and say, oh, I meant this, not that. Very important. We got to be able to hold people clearly accountable for the information that they give us. That's why Solomon R.C. Ali Corporation is so, so important. Go to our website at solomonrcali.info and you'll see some of this information where you'll be able to begin to understand, especially on some of the deals that we have done. All right? And that's very important. Clear communications. I can't know that you're just talking about fruit. I need to narrow it all the way down because I have to be able to hang my hat on, hey, Mary said this. This is when she said it. This is how she said it. This was the conversation. This is what I took from that conversation. So once the report and the strategy is done and we're sharing the strategy and the report, Mary can't come back and say, well, I didn't mean that. Okay? Mary's going to have to hold her hand up and confess, oh, yeah, that's what I said, yeah. Okay. And the same on the other end. If I don't understand, and I'm the one doing the investigation and the due diligence, it's on me. The burden is on me to get the answers, to get to the bottom of it. Now, if I'm not talking to none of their humans, none of their employees or management or anything of that nature, I'm just doing due diligence based on filings, SEC filings, regulatory filings, things like that, okay? It's going to be a little harder to get clear communication, but what you can do, all right, is compare that to other companies, all right, to see. Because there should be a common thread going right across one company to the other, especially if they're in the same industry. So that's how you'll make sure that you got clear communications, things of that nature. Because even if you read it, even if it's in the filings, you don't want to take it for granted that that's exactly what they meant. You need to be 100% sure, okay?
Start of the day and end of the day are good ones, with sufficient time in between to do your research and generate findings. Not only do you communicate back to the senior management of the acquiring company,
day, ain't it?
you also need to keep your contacts at the target company updated on whatever you need to get the help you need.
I'm just going to say this, people. You see these hours here, 8 in the morning? You know what time 2200 is? Anybody know what time 2200 is? That's 10 o'clock at night. That's a really long day. That means that person did a 14-hour day. And guys, girls, ladies, gentlemen, whatever you want to be called, this is not just one day. This may go on for months. Sometimes just doing a transaction with a business, all right, can take 6 months up to a year and a half, depending on the size of the business. And people will be putting in this kind of hours. To do due diligence is very, very expensive. To hire attorneys and accountants and things of that nature. Can you imagine a law firm, some attorneys, at $500 an hour, working a 14-hour day? That's a lot of money. Yeah, I mean, it's ka-ching, 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 fast. You know, so, and what, $500 an hour? Man, 14 hours? You're already at a $7,500 bill every single day. And I know most of you can't afford that. Most of you cannot afford to be spending $7,500 per day, people, on, and this is just one part of the due diligence. It's not the whole thing. So they may be at that for months. That's why you hire, if you're a business owner, if you're an investor, that's why you hire a Solomon R.C. Ali Corporation. because my team and I, we get in there, we do the same exact thing, okay, and we take it to our attorneys who are already on our clock. See, you're not having to pay another attorney. We already have attorneys. We already have accountants, all right? So we're taking it to our people who are already on our clock, but we do most of all of that go for work, so that when we turn it over to them, they may only have to spend a couple of hours on it. So it brings the cost down considerably. And a lot of times the attorneys and stuff appreciate that because someone else is doing all that grunt work, okay? Even when they have paralegals, so we'll bring it to them. They'll give it to their paralegals, and then they'll oversee it and look at it. But now all the grunt work and everything's been done. See, if I was buying a company, it could cost me anywhere from $35,000 to $100,000, depending on the size of the company, just in due diligence. It's a lot of money. Okay, so I want you guys to keep that in mind. So when you're thinking about the importance of due diligence, how important it is, it's extremely important. If you are an investor, you should be doing the due diligence yourself. If you're an investor, a retail investor investing in stocks or looking to get into stocks in its early stages, you should be doing the due diligence yourself, or you should be reaching out to a company like SolomonRCAli.info, who goes out and does the due diligence, looking at management, looking at the financial history, putting models and everything of that nature together to see how the company may perform in that particular industry, in that sector, okay? So please keep that in mind. We're going to go back to the video.
Lots of people will want an update from the team on the progress. Don't let this distract you too much from getting the work done. It's good to agree on regular touch points with key stakeholders in the process. Start of the day and end of the day are good ones, with sufficient time in between to do your research and generate findings. Not only do you communicate back to the senior management of the acquiring company, you also need to keep your contacts at the target company updated on whatever you need to get the help you need, get the documents you need, and whether you have access to the persons you need to speak to. How do we make sure we get a full picture? What if the target company fails to disclose relevant information? It's important to ask a significant number of open-ended questions. Things like, what else should we be aware of regarding your service delivery?
People, if I'm the buyer, okay, and I'm going to require the seller, if I'm the buyer, they're telling me I need to speak up a little bit. So, hey, can you hear me now? All right. Listen, if I'm the buyer, all right, I'm going to require 25% is held back in escrow for at least a year to 2 years. No ifs, ands, and buts. Why? Because if they have given me any wrong information, any information that we have missed, pending litigations that weren't pending at the time, but they knew about it and everything of that nature, because sometimes people play games. It's not a lawsuit currently. It hasn't been filed, so they honestly can say, well, no, we don't have a pending litigation. Well, the truth of the matter is they may have received a letter about one coming down the pipe, but they sold the company before it came down the pipe, and now it's my problem? No, I didn't make the error. So again, that's why I would hold money back in escrow to ensure things like that don't happen. It could be, they failed to pay some taxes or something of that nature. Again, if you got the money sitting there in escrow, you can go ahead and take care. And it's most common with payroll taxes and franchise taxes. That's the two most common, is the franchise taxes and payroll taxes. So you always want to make sure you hold some money back in escrow when you close the deal, just for those cases.
Delivery process? Or are there any concerns or open cases regarding the environment, health and safety? Questions like this emphasize the seller's obligation to disclose. It's advisable to withhold part of the total acquisition sum on the deal signing. That way, if any material items come up later that should have been disclosed during the due diligence process, you can withhold payment until the issue is resolved, rather than having to look for compensation in court for information that was misleadingly withheld. There is a difference between a substantial risk in a due diligence and an improvement opportunity. The target company...
I'm going to try to give you the visualization. Before I close any transaction, I have visualized that deal all the way through. The pros, the cons, the negatives, everything like that, the synergy. So that's what I'm pointing out right now. See, this company here might have a great marketing team. This company might have a lousy marketing team, right? So we're going to eliminate this marketing team. See, now it's becoming synergies. This company may have an excellent payroll administrator, all right? These companies may have lousy. So I'm going to eliminate all the other payroll administrative people, and we're going to pile that right there. All right, you get the point? Same with marketing. All of these companies have marketing people. So I'm going to eliminate the marketing of 1, 2, 3, 4, and we may just use the marketing at 1. So that means I get rid of all the duplications. All right, I'm getting rid of all the duplications. And the idea of doing that is to be able to make more profit. All right. Now, I'll be remiss if I don't say this. Most acquisitions fail, people, because they fail to be able to merge the cultures together. Most acquisitions fail because they can't merge the cultures together. All right? So they don't work and they end up having to be unwound or later or sold off or stuff like that. Okay. Let's go back and let's finish this baby up. This was really good.
You might be running some aspects of the business in a way that you disagree with, but it does not necessarily mean it is a business risk. While working on the due diligence, visualize the post-closing situation. What does the combined company look like once the pieces of the puzzle are put together? You can also add value by helping to prioritize the integration priorities and risks. The final step of your due diligence project could be to provide a briefing and do a handover to the integration team. There you have it, 10 valuable due diligence tips. Take it seriously, right-size the team, put together a diverse team, confidentiality at all times, good checklist and a good brainstorm.
People, let's go through their 10 real quick. Let's leave it up for a minute, all right? So this is what they're talking about. This was his valuable due diligence tips. People, when you're doing due diligence, here's the thing. Solomon R.C. Ali Corporation, here's what Solomon Ali says. Pay attention to management. Historically, you want to focus on that. Pay attention to the company. Double digit or triple digit. Most other professionals are going to tell you double digit. What am I going to tell you? Come on, get this right. Triple digit, people. You want to see triple digit growth from that company, all right? Industry. Third, industry. All right, the industry must be growing or have the ability to grow. All right, so industry, it's got to be on the upswing. Very important. All right, the next fourth thing that I like and believe in, management has to be putting money back into their business to scale their business. All right, to make it more, one, profitable, but to scale it to grow its revenue. All right. So please keep that in mind. Those are the things that's going to bring you the returns. Those are the things that if you're a CEO or a management team, that's going to help you to be bankable. That's going to help an investor want to invest in your company. The other thing is I'm always looking at who's on your board of directors. All right, so your board of directors should read like a who's who. You should have key people in there, all right, who know and understand your industry, who knows and understand how to run and operate a business. If you have a board of directors and I'm doing my due diligence and I see, oh, you just pulled up your friend from down the street or your mom or your cousin and things like that, guess what? Your business have no credibility at that point. Very important, all right? Very important. If you want people to invest, do the right things, do the work, all right? Do the work. Listen, everyone, I really want to thank you so very much for tuning in to Minority Business Access. Yes, my team is waving me off of here. Okay, I guess they got some other things they have to do. Probably go find videos for you guys. Okay, but hey, it's been really fun. It's been really exciting. Thank you for tuning in. Look forward to the next episode and bringing you some more very, very valuable content. And again, if you have any questions, please don't hesitate to go to SolomonRCAli.info. Again, that's SolomonRCAli.info. Do not hesitate. My team is there to help you, work you through whether you're an investor looking for a good investment and things like that, and just want to know how to do the due diligence and everything. Remember now, we're not promoters. We're not market makers or broker dealers. We're not trying to sell you on those stocks or ideas or anything like that. We're trying to educate everyone just on how it's done and why it's done in the manner that it's done so that you can be successful and have a better future for you and your family. Have a wonderful week.
You've reached the end of another episode of the Minority Business Access Podcast. Connect with us at SolomonRCAli.info to leave a review and access more resources. We hope you enjoyed this show and found great value. See you at the next episode.